And all right, welcome everybody to another awesome Voltz community call. Today we're going to be diving into what's new at Voltz. We've got a lot of exciting stuff to cover, especially around the new staked ETH pools, but we'll also look back on some of the milestones that we hit as a project and as a community during the first half of this year. Big shout out to those who have already submitted their questions for today's call. I've taken note of them and we'll do our best to address them all. You can also leave questions in the chat section of the voice channel as we proceed. So if you notice, this is one of the new style of Discord chats. If you look in the upper right corner, you'll see a little chat box where you can type in here. So I've dropped a little message there. So go ahead and if you have any questions as the call goes on, just leave them right in there. No problem. All right. So, first things first, we have some really exciting news with a new team member joining Voltz Labs. So, we're going to have Simon introduce the newest member to Voltz Labs, Joanna. So, Simon.
Yeah, we're super excited to have Joanna join the team. So she is joining us as another kind of software engineer and comes with a first class degree in computer science from the University of Warwick. So if anyone's kind of more familiar or less familiar with what a first means, that's basically the top grades you can get in the UK, which is kind of the same as I think, frankly, everybody in the engineering team. So we've added another superstar there. And in terms of other stuff that she's done, actually, she spent a bit of time at City, so kind of working in TradFi. But despite working in TradFi, had been doing some side projects of her own, which included writing an Ethereum developer blog. So she kind of very clearly wanted to make the switch into a DeFi team, and we found her and we liked her, and we're super excited to have her. So welcome, Iona, and excited to have you in the team.
Yeah, it's definitely great to have her. And now we'll invite her up to give a big speech. Just kidding. Just kidding. Don't worry. Um, but I see she's on the call. So, before we dive into what else is new at Volts, I just want to talk a little bit about the Discord hack that happened a couple weeks ago. Touch upon the lessons learned and explore how it will ultimately make us stronger as a community of builders and interest rate swap traders. So here's the deal from my perspective. I know I was off for a week, but now I'm back and ready to dive in and start building again. So as most of you probably know, our community was targeted by some hackers who have unfortunately scammed several other projects with a similar kind of attack. They used a combination of a novel Discord exploit and social engineering to compromise my account. So, as a community lead here at Volts, I've always taken time to listen to the ideas and concerns of individual community members in order to bring the project forward as a collective. And the vast majority of those conversations have been honest, they've been constructive, and they've been held with really good intentions. I've met so many incredible people through our community here. So unfortunately, a bad actor slipped through and essentially tricked me. And now we have to make some changes to ensure that it doesn't happen again. So we've been consulting with some security experts to work on ways that we can protect our server from future attacks. There have already been several steps taken to tighten our server security, but we also have to change a little bit the way that we communicate with individual community members, especially over DMs. So for now, as a cautionary measure, we'll be restricting the use of direct messaging with Volts Labs teammates. So I apologize to those who I had open conversations with that were cut short. I know there was a few of you out there that may not have heard back from me for a while, and that is why. Um, so now that we've kind of moved past that struggle, we can see that this is really an opportunity for us to clarify our goals as a community. Kind of shake out any bad actors and focus on building the protocol with an even stronger sense of purpose. With that in mind, you might notice some changes coming to our server in the coming weeks, making for a more streamlined and efficient community of builders and traders. I'm really excited to show you all what we have in store for the server, just making it easier to access, easier to to use. Really, no one, not even these scammers, can stop us from making Voltz Protocol one of the most powerful financial tools in the world. So I hope we're all, feeling encouraged despite this unfortunate event. And I want to thank everybody also that's kind of shared their support, because that has been a challenging time for sure. Uh, but with that, looking forward with a lot of optimism, I know I am. Let's turn it over to Simon to give us a recap of, just how far Volt's protocol has come this year, and then we're going to also have him talk a bit about the new staked ETH pools that were recently launched. So, Simon, can you talk a bit about where Voltz was at the beginning of the year and what was achieved in just 6 months' time?
Yeah, sure. And just perhaps moving on to that, it's worth kind of adding some stuff on the hack. So it's obviously something which we never want to happen. As well as said, there's some social engineering and is kind of exploiting a kind of a smart or a smart exploit on Discord, which enabled them to do it. But for us going forward, we have already taken some pretty significant steps to improve the security of the server. We want the server to be a place where the whole community can come in and discuss ideas with one another, discuss ideas with the Voltz Labs team, and then ultimately become a place where people can meet other builders, people can start projects. Voltz as a primitive is very much creating a new market, and off the back of that, there are lots and lots and lots of both trading opportunities, but also building opportunities that exist. So there's almost like this huge white space that's been created, and what we want the server to be is we want the server to be a place where people can come together and discuss those new ideas and new opportunities and actually start building them together. So obviously we don't want to repeat everything that Will said, but there's going to be some changes to help make that kind of more possible, and really excited about kind of what that means for everybody as a community going forwards. To then talk to Will's point on how far we've come this year, the point here really is we've actually hit the halfway mark in the year, and it's often a good time. We spend so much time thinking about the future, but it's actually often a good time to just reflect on how far we've come as a community, as a Voltz Labs team, as a project. Because if we go back actually all the way to the beginning of January, Voltz kind of really wasn't much. There was 4 people in the Voltz Labs team. There wasn't an app. There was some very early smart contract logic, and there was some very, very early beginnings of a community, but still relatively small. And if we look to where we got to at the end of June, actually that had completely changed. The kind of protocol was clearly live, and in actual fact, it is and was back then, and it continues to be the most liquid interest rate swap exchange in the whole of DeFi. I think actually now it's hitting over 60 million of liquidity available to trade. And then alongside that, obviously, in order to do that, there has to be an app. So the app's live, and I think we are pretty confident when we say it's easily top 3 UI in the whole of DeFi, which is obviously testament to the design work of Broccoli and the rest of the engineering team for getting that live. But then alongside that, even if we just start looking both at the people involved, the community has obviously grown massively. We've got some amazing teams coming through, doing all sorts of stuff, be it building stuff like liquidator bots that help keep the protocol and ecosystem healthy and safe. Sorry, through to teams doing or building way more complicated ideas, which can range from kind of building primitives that use Voltz Protocol as a form of stablecoin collateralization, all the way through to things which are kind of a lot more sophisticated from a financial perspective, like kind of creating swaptions and bringing that on chain. So there's been some amazing progress. Actually, if we take a step back and kind of look at what we've been able to achieve over the past 6 months, but then looking forward to the next 6 months, actually, if we kind of look at that and draw some sort of trajectory, the trajectory there is clearly exponential. So over the next 6 months of this year and by the end of the year, there are some incredible kind of things that we have in the pipeline from a Voltz Labs perspective, but then also just from the community more broadly, we expect and want to help more and more teams come through with their own ideas on what they can build on top of the protocol, and help get those ideas live. And if anything, like Voltz has the potential to be a breeding ground for an army of new primitives that get created off the back of this new market existing within DeFi. And that is a really exciting thing that we're looking forward to for the next part of this year. And then that, I think, brings us on to the pools that we just launched, or at least launched at the beginning of this month. So there was an article written by Will, actually, that went out earlier today, talking about the ETH staking pools. Essentially, we launched, for anyone that didn't see it, we launched pools on top of Lido and on top of Rocket. So STETH and RETH pools, which basically means you can trade those kind of variable rates with leverage, or you can trade the fixed rate of return on Voltz Protocol. And there's all sorts of different kind of trading opportunities that kind of spin up off the back of that, and not just trading opportunities, actually opportunities for builders as well to build new primitives. But one of the biggest ones is clearly the merge. And I don't want to steal your thunder here, Will, so I'm sure there's some things that you want to add to this. But the article that we put out earlier today kind of talked through the fact that actually when the merge takes place, one of the kind of big changes that is likely to happen is that the economic throughput of validator nodes is expected to change pretty substantially. And in fact, actually, the Ethereum Foundation, I think, have estimated it's likely to increase the rates of return for people running nodes by around 50%. And what that actually means is it means it's likely to translate into an increased rate of return on STETH or RETH, which means, if you think about that in the context of Voltz, Voltz Protocol has actually created the first real way to execute a trade around the merge that is not focused on the kind of hoping it translates into the price of ETH changing, but is instead focused on what is actually going to happen, which is that the economic throughput of these nodes is going to, or likely to, change. So there's that whole article there where we talk through kind of how you can start placing those trades if you believe that is going to happen through the second half of this year. But actually, the macro point is that as a primitive and as a community, we have created the very first market where you can actually properly execute trades around the merge, and that is pretty exciting. Well, I don't know if there's
Yeah,
anything you want to add to that.
absolutely. I mean, I think it's worth hanging on this point for a while. Maybe I'd love to hear more from you a little bit on really why trading rates is the best way to kind of trade the merge, right? Because if people are stacking ETH right now, thinking, oh, the price of ETH might change, after the merge, that is clearly, sort of bound to kind of the macro crypto ebbs and flows. So why are rates a better thing to swap leading up to the merge? If you can expand on that a little bit.
Yeah, so maybe to talk to the ETH point first. So if you're trading ETH at the moment and hoping that the price of ETH will change post merge, that may well be true, but the price of ETH is also dependent on many other factors, which are not related to the merge. So you're kind of exposed to all of those other factors in an attempt to get exposure to the merge. Whereas if you're trading rates, if you actually look at the rates of return that are coming out of kind of Lido or Rocket or any other liquid kind of staking provider, they've been relatively stable through both bull and bear markets, which is kind of logical because it's the rates are kind of driven off essentially the demand for block space, and that obviously does change a little bit in bull and bear markets, but it's not changing to the same degree as the price of ETH or kind of another token might change. So when we then project that forwards to the next 6 months, if you believe that the merge is going to happen within that time frame, all of a sudden you're not exposed to all of these other external factors, which might kind of translate into kind of like a negative return on the trade that you execute. And instead, because what's fundamentally going to happen at a technical level when Ethereum moves from proof of work to proof of stake, you're going to have the economic throughput of these nodes changing, which means that you don't have these kind of other external factors that you're exposed to when you're trading the rate relative to trading ETH as a token. But instead, you are exposed to actually what's likely to happen at the merge, which is that the economic throughput of these nodes is going to change. So you've removed essentially, there's not, you haven't completely removed the noise, but you've removed a lot of the noise, and then you at the same time are still exposed to the upside from the fact that post merge the economic throughput is going to change.
Yeah, that's amazing. And one of the things that kind of blew my mind when I was researching this and how we can use Voltz to kind of trade the merge is just how easy it is. I mean, it might seem complicated at first, trading rates around the merge, but maybe you can walk through just how easy it is. I mean, it's pretty much a three-step process, right? If you let's say I'm in the position of someone who believes that rates will go up post merge. What do I need to do on Volts? And I'll also refer everybody to our Twitter thread that just went out.
Yeah, so if you believe rates will go up post merge, then you essentially want to be long kind of rate ETH staking rates, which means on Volts you want to be what we describe as a variable taker, and if you go essentially long rates and those rates move up, there's a chance that you generate pretty substantial returns. The reason I say that there's a chance is essentially what you're doing as a variable taker is you are selling the fixed rate in exchange for the variable. So what you want to then happen in order to generate returns is you want the variable through the course of like the life of your trade to be higher on average than the fixed rate at the point that you entered the pool. So just for argument's sake, imagine the fixed goes to like 50%. Well, do you believe that kind of liquid staking rates are going to go up to 50%? Maybe not. But at which point you wouldn't be generating money. But the fixed is not at 50% right now. The fixed is, I think, a lot more kind of comparable to the current variable rate. So if you're selling that into the AMM in exchange for exposure to the variable rate, if the variable rate does go up, then you're exposed to the upside.
Right, and just to remind everybody, all you need to do to trade in these pools is have ETH. You don't need some might have the misconception that they need they need to already have staked ETH or our ETH, but all you need is ETH to enter into these pools, which makes it incredibly accessible. Any more
Yeah.
points you'd like to add on the pools?
Yeah, well, maybe just given you mention it. So, if you think about our stablecoin pools, so if you take AUSDC, for example, if you're trading via the FCM, so basically a fully collateralized trade, you can deposit AUSDC. So it's not just USDC. But the reason for that is those types of pools, obviously AUSDC is one for one redeemable for USDC. Before the merge, we made a decision that you can't use STETH or RETH as a form of collateral. You can only use ETH, and that basically means that anybody trading in the pool, their positions are being collateralized by positions on the other side, where it's only ever going to be ETH. That just removes any kind of issues, for want of a better word, around the so-called STETH depegging. Which actually isn't depegging, but that's another story. But it just means that everybody's going to be collateralized by ETH in the pool. So we don't have these issues around what is the price of STETH or what is the price of RETH.
Very cool, very cool. Yeah, this is like really fun topic to dive into, and we should do it more in future calls. And if anyone has any questions or comments to add, a reminder, you can just add it into the chat in this channel. So with that, I think we want to move over to hear from the development team at Voltz Labs. They've got some really exciting, like novel stuff in the works. Specifically, I think we want to talk about something called the Strategy Backtesting Framework, or SBF, today. So I'm going to hand this over to either Mike or Arthur to answer these questions. So Mike or Arthur, I'll just have you chime in. But we've just today open sourced the alpha version of the Strategy Backtesting Framework, or SBF. Can one of you give an overview of what the SBF is and the function it serves in the Voltz ecosystem?
Sure. I guess I can kick off and then see if Mike wants to jump in. So um, the power of Voltz stems from the fact that it enables a range of different, very interesting strategies that can leverage the fact that you're able to effectively express your views on directional interest rate movements, be it on top of stablecoin pools or be it on top of liquid staking pools. And we have done a lot of research around how traders can go about arbitraging those rates, how they can go about extracting alpha from those pools. And then whenever you are kind of thinking about these things, you really want to, before executing any sort of live trade, you really want to first backtest your strategy. And we have done our research and we haven't really identified a nice framework that would enable us to do that. So we've kind of taken a ground up approach of designing all of the necessary infrastructure and plumbing that would enable any trader to step into our GitHub repository and write up their own strategy. And the way that the strategy backtesting framework works is it has a bunch of modules. At the highest level, it has a strategy module which lets you define how you would go about generating signals, be it long or short, on top of a given pool. It has a data module which you can supply historical data on historical rates such as liquid staking rates on Lido or AUSDC rates on Aave. And the final bit of the puzzle is the execution handler, which effectively lets you mimic how a trade would be executed by supplying your a model of slippage or a model of how a trade could be filled. With the strategy backtesting framework, you don't really need to kind of dive into the complexities of how this plumbing works. All you need to do is come up with a data set that you want to leverage, and then think of a strategy on top of this data set. So maybe if we go back to the staking example, there's a reason why we launched both Rocket and Lido pools, is because we believe that there are huge opportunities to kind of arbitrage the rates between Lido and Rocket. A simple strategy would be to try and effectively estimate kind of the mean rate for each pool and kind of plot this moving average value. And then whenever the strategy sees an opportunity where the fixed rates are too far apart between the Rocket and Lido pools, you could effectively short the market, which has a higher rate, fixed rate, and then long the market, which has a lower fixed rate, and effectively capture the delta. Other kind of very interesting strategies that you could think about are centered around the concept of mean reversion. So one thing that we have observed, both in traditional markets, but also by looking into DeFi interest rate markets, is that interest rates tend to be mean reverting, meaning that over time they tend to fluctuate around some sort of equilibrium interest rate value. So what you can do as a simple strategy is constantly update your mean value that you're extracting by querying and looking back into the historical rates. And then if you then observe the APY to be lower or upper or higher than that kind of long-term value, you could execute a trade that tries to kind of arbitrage that delta and effectively generate alpha and PNL. The cool thing about this framework is that it's fully event-driven. So the way it works is different parts of the infrastructure generate events in the form of signals, and then those signals get translated into orders that can be executed. So if you're doing it in a backtesting environment, you can just use historical data, but you can easily take it one step further and wire up the SBF with the live Voltz contracts, deploy the SBF on some sort of AWS instance, and then let the strategy run itself and continuously pick up signals and execute VT and FT trades on the pool that is built on top of. Another interesting feature of the SBF is that it could be used as a backbone for strategy vaults that effectively aim to kind of pool capital from a range of different retail investors and then execute those strategies on their behalf. So in order to do something like this, you could design a vault similar to how you would design a Yorn vault or a Mellow vault, and then have a function which extracts those signals and then pools collateral to kind of spread the gas costs across a range of different depositors. When thinking about how to design the SBF, we also incorporated a few very interesting metrics that are kind of valuable when analyzing strategy performance. So off the back of each kind of backtest, we generate the Sharpe ratio of a strategy, which effectively tells you your risk-adjusted returns. It also generates the so-called maximum drawdown, which is effectively a value that tells you over the course of your strategy backtest what is the maximum amount of loss that the strategy could generate. And if you take a very kind of slow and step-by-step approach when thinking about those strategies, you should be able to carefully think through all the risks and P&L opportunities. And then once you are confident, you could then wire up the SBF with the live contracts, do a little bit of trading against those live contracts. And then if you're confident that the strategy is actually performing well, there's an opportunity to deploy more capital or potentially deploy a community governed pool that kind of implements the strategy on their behalf. But I wonder if, Mike, you want to jump in and add more thoughts.
Yeah, unfortunately, Mike's Discord is messing up as Discord loves to do. So it's just you, Arthur, here answering things about the SBF. But it is super exciting. If there's any other, if Simon, if you wanna add some points, or anyone else, feel free to jump in. And I'd like to, yeah, go ahead.
Well, I was going to say, Arte, I mean, I don't want to put you on the spot here, but it may be worth you just sharing your screen and directing people to the repo, just to give a bit of extra context. I think that's always helpful.
Sure, let me do it now. I'm just navigating to the SBF repository. Let me see if I can share my screen. So, let's see. Can you guys see this?
Yep.
Yeah, we can see it.
So this is the link to the repo, and let me just actually post it here. This is the strategy backtesting framework. Let's just briefly go through the README. So we've tried to kind of write up all the kind of necessary documentation that will help you navigate that. But the highest level, the framework is made up of 4 key elements. So it's made up of the data module, which produces market events. So it handles the receiving of new market data, such as new rate updates, be it in a backtesting environment or in a live trading environment. Then what happens is those events get passed over to the strategy module, which takes those data points and then runs some sort of signal production function that then generates either a long signal or a short signal. This is then received by the portfolio, which takes those signals and generates order events. And order events determine the size of the position that you want to take. So the signal engine generates the signals, but the portfolio generates the size of the position you want to take. And then once the portfolio has generated the order, it then gets passed over to the execution handler, which is responsible for either executing the transaction against a live environment or executing it against a dummy kind of backtesting environment. And once an order is filled, it produces a fill event, which notifies us of how much slippage has been incurred, how much you have paid in fees, and what sort of position size you managed to execute based on the available amount of liquidity in the given pool. So if you want to go slightly deeper into each component, we can briefly jump into the data module, so the data.py file. So it's just an abstract data handler class, which has a couple of methods. So the first method is just lets you get latest rates for a given underlying, and the other method lets you update those rates, which basically pushes those rates to the signal engine for it to then process them. And a simple example of how you could leverage the data handler is you could build a historical CSV data handler, which wraps the abstract data handler class. And all it would do is it would take this CSV data series and generate event-based data streams that SBF can handle. And there are a couple of supporting functions that let you effectively process the data in the format that's most helpful for your strategy. If you then move on to the strategy module, you can just navigate to the strategy.py file in the SBF. Again, we have an abstract strategy class, which effectively acts as a wrapper around any strategy that you would like to build. And it has a function called create signal, which effectively takes as its input a data event, which could be an interest rate supplied by the data handler. And a simple example of a strategy would be something like a long rate strategy, where whenever you get a signal, whenever you get a data, which is flagged as a market event, it just takes a very simple long view by initiating a signal with a long string. And then once this is initiated, it then pushes this signal back into the events buffer. So then once that's done, we can then go into the portfolio, which is again a wrapper class, which, if we try and like build on top of it, we can build out a very simple naive portfolio that effectively has two key functions: the update signal functions and the update fill function. If we navigate to the update signal function, so let's try and find it. Update signal. In this very specific simple scenario, we generate an order event by calling the generate naive order function, which all it does is just creates an order. You provide a token that you want to trade, which can be AUSDC. You provide a timestamp at which you're trading. You provide a direction, and then you provide how much notional you want to trade and how much margin you want to supply. Again, we're using very simple, naive functions in this dummy example, where if we navigate to here, we have some amount of initial capital that we want to deploy, and a parameter called leverage that tells us what the ratio between notional and margin should be. And then the update fill event within the portfolio effectively reads and listens to events that are coming from the execution handler to process them in order to then update your equity curve. And once it does that, once you then manage to fill your positions, you can generate an equity curve and analyze your returns. So let's just go through a couple more interesting functions here that might be helpful. So there's a function that constructs all of your positions initially, that generates your swaps. Then there's a function that computes the total value of your positions by effectively cycling through all the swaps that you have initiated throughout your strategy execution. and then calculate the total cash flows that would come out of those positions. And then the total cash flows are a function of the variable rates and the fixed rates that you have managed to secure. So for example, in a very dummy example where you have a variable taker position, your cash flow will effectively be equal to notional times the delta between the variable rate and the fixed rate you have secured, times the time in years that has passed since you've initially entered into a swap. So that's kind of the high level of the portfolio. And then there's another very interesting function here that I'm just trying to find, which is called create equity curve data frame. All this function does is as soon as the backtest is finished running, it collects all of your positions across as a time series and then produces an equity curve which tells you how much in terms of returns your positions have generated from the initiation of the backtest and until the end of the backtest run. And then last but not least, there is a very kind of handy function called output summary stats, which takes your equity curve as an input and then produces various metrics such as the Sharpe ratio, the drawdown, the returns generated by the strategy. And then once you have this data, then you can then kind of think about how your strategy has performed. And then if you have a bunch of different strategies lined up, you can compare their Sharpe ratios and pick the one that has the highest, and then kind of use it in a live trading environment. And I guess the final bit is the execution handler, which effectively executes orders. So in a dummy kind of environment where you're just simulating, you're just generating simple fill events, and you're passing the fee as 0. But if you were to build something that's more realistic, you would just take the execution handler abstract class, wrap a new live execution handler on top of it, and then incorporate some sort of a slippage model or a fee model that will give you a better idea of your actual, more realistic returns rather than the theoretical ones that you would get. And then finally, we also have a backtest function, which kind of gathers all of these modules into a single class called, in this case, long-range strategy backtest. So it brings the historical data set, it brings the strategy, it brings the portfolio and the execution handler. And then once all of these are lined up, it creates the event loop, which then cycles through all of the historical data points, generates the signals, updates the portfolio, and then once the event loop is done, you can then call the summary statistic function from the portfolio to kind of generate plots that would help you judge the performance of your strategy. So that's kind of like a high-level overview of the SBF, and we are still continuously working on it and thinking about new strategies, but we highly encourage the community to jump into the SBF, ask any questions, and we'll be more than happy to support you in the next big alpha-generating strategy that you build.
Yeah, absolutely. And I'll just remind everyone that that is now open source at our GitHub. So head over to the Voltz Protocol GitHub to dive into the SBF and learn all about it. It's truly cutting edge stuff, super exciting. Now I think it's time to move on to some calls. Oh, I see that Artur has dropped a link to the SBF section of our GitHub in the chat here, so you can head on over there. Now I think we have some community questions to get to. I'm just going to kind of ask them, and either Artur or Simon can pick them up. First off, we have a couple left in our chat from FOMO Sapien. First one here is, can someone tell me the process of Voltz for finding out the variable APY for our ETH? Are you using the Rocket Pool API?
Yes. So I mean, I can answer this quickly. So the very high level is that we have an on-chain rate oracle that pulls those rates through on-chain into Voltz protocol. That is actually done with a very specific look-back window, which enables us to kind of smooth out some of those, or it doesn't enable us to smooth out, it enables us to create the variable APY and understand what the variable APY looks like. But the very high level is essentially for all of the markets that we have live on Voltz Protocol today. They are built using on-chain rate oracles.
Okay, great. And another one from FOMO Sapien, which is an awesome name. Simon, I was reading through your Twitter post on the strategy between AUSDC and CDAI. I would like to know more about how the graph to show the divergence and convergence of USDC Aave long short and DAI compound long short is drawn. I'm not having much of a trading finance background, and hence my question may be naive. Could you care to explain?
Yeah, sure. So with these pairs, what we did is we did some analysis just to understand how highly correlated the two assets are from a rate perspective. And basically, what you can see when you start to do that analysis is that they are highly correlated, which basically means that when the rates diverge, that they are likely to converge at some point again in the future. Which is relatively logical because it's just for argument's sake, imagine the rate of return on AUSDC jumped to 10%, but the rate of CDAI was still at 1. Over time, people would move their kind of stablecoin assets from CDAI across to AUSDC, at which point the rates would just naturally change off the fact that there's more supply of AUSDC and less supply of CDAI in this example. So that kind of mean that what that means when you have this diverge but then converge type pattern, it basically means that you can conclude that the rates exhibit some form of mean reversing behavior as a pair. And then what that means from a trading strategy perspective is it means that when one is higher than the other, you can basically short the one which is higher than the other one, and you can go long the one which is lower than the other one, with the degree of confidence that they are going to come back, i.e., they're going to converge at some point in the future. And that is essentially what we put into that tweet, and what that chart shows is it actually shows signals. So you could use the SBF, and in actual fact, we did use the SBF or a version of it in order to create those charts in the first place, or in order to create the signals which creates the charts in the first place. And that's what that chart is showing. It's just showing at these points in time, kind of like signals are showing that we should be longing one of those rates and shorting the other rate. And actually, if you kind of do that over a period of time, what you can see in some of the later charts in that tweet is that you're able to pick up essentially market neutral returns off the back of that strategy.
Amazing. Okay, we have time for a couple more questions, I believe. So we're going to take a couple from Zek here. First off, he says the team has a pretty good handle on the best assets that are coming online, but how does Voltz Lab determine which assets to create IRS pools out of? What does that process look like for determining which assets to make pools from?
Yeah, it's a great question, and if I remember correctly, there was a part of that question that also talked about whether or not pools should always be created in pairs. I don't know whether some of that is driven off, for example, that tweet that we talked about with where you can trade the fact that AUSDC and CDAI exhibit some sort of mean reversing behavior, so you can long one short the other, and essentially deploy that statistical arbitrage strategy that we put out. The answer to do they need to be in pairs? The answer is no. And actually, kind of some of the stuff that we've put out today, for example, around being able to trade the merge, you could just do that on one pool. So you could do that on the R-ETH pool, or you could do it on the ST-ETH pool, or you could do it on both. But you don't necessarily need to be trading between the two. It does become more interesting at times, kind of releasing these in pairs or in triplets, because it means that you can start to do some sort of like trading strategies, or kind of create trading strategies that go across those different markets, which is why we have done that so far. But in terms of thinking about markets going forwards, there's just so much that we can do. And the way that we really think about it is kind of like, what does this market unlock? what is it that the community wants as well. I think that's an important part of it. And then we go about kind of basically creating those markets.
That's right.
Yeah,
And
yeah.
yeah, go ahead.
Just
Mhm.
yeah, I guess the main point there is at the fundamental level, Voltz is a primitive, but at the end of the day, the utility is derived from the products and the strategies that could be run on top of this primitive. So whenever we think about kind of which pools and which kind of assets to launch on top of, we always try to think about kind of the end utility that we're trying to provide. And the end utility can be in the form of strategies that we're trying to unlock, but it can also be in the form of products that could be built on top of those pools. So be it a fixed rate lending vault or potentially a fixed rate borrowing vault. And the main motivating factor is the end utility and the value that we can provide to the users of those pools. And obviously another kind of important aspect is the amount of liquidity and TVL available in the underlying pools really gives us a good idea of how useful those pools are already to the existing kind of user base of underlying protocols, which then drives value to bring interest rate derivatives that kind of sit on top of those.
Great. Fantastic. So let's do one more question here, if you have time. From Zek, we have, for the Voltz ecosystem, has the team considered setting up a Voltz grant to fund products that are based on Voltz, including Voltz education, fixed rate products, etc.? Any news on the grant program?
Yeah, it's a good question, this. Obviously, we don't have a token at the moment. And if we look at a lot of the grants programs that exist for other projects, typically those grants are paid in the underlying token. Not always, but typically. Um, so that does have some limiting effect to the amount of money that we can basically put behind a grants program. But it is still something which we are exploring, and we're obviously keen to help teams get up and live. And sometimes there are things which, as a Voltz Labs team, we think would be really good for the community to pick up. So it's not something which is live yet, but certainly exploring a grants program is something which we're doing at the moment.
Amazing. Well, that's a good note to end on. Thanks so much, everyone, for joining. A lot of really exciting stuff happening. Thanks for giving us such an in-depth demo of the SBF. Well, I guess it was pretty surface level, but still amazing, Arthur, and everyone for joining. Thanks for your questions, and we'll see you in next week's Twitter space. Bye-bye, everyone.
Cool. Thanks, everybody. Bye bye.
Thank you.
Thanks, everyone. Bye bye.
Bye-bye.